Okay, very good morning and welcome to the briefing for Wednesday the 4th of January. Obviously my first time back in the hot seat for 2017, so I hope everyone had a fantastic Christmas and New Year's. And certainly hasn't taken the markets too long to get back into the swing of things. Certainly yesterday, extremely volatile day in terms of oil prices in particular, and we'll talk about that in a bit more detail shortly. But certainly after, you probably saw the stat that Piers was touting yesterday in regards to the DAX. I think it was the last week of 2016. It was the narrowest range in the DAX future in 20 years. And certainly we broke that yesterday. Certainly the beginning of January, really. Just taking a look here on the DAX, you can see in the center left chart, you had that big pop up on the 2nd. So although bank holiday, the Eurex market was open, and we did have some economic data in the form of the various European manufacturing PMIs, of which have been surprisingly strong. You had France, Germany, multi-year highs, and that caused in fairly thin markets the move to be somewhat exacerbated, taking out some technical levels, and then we shot higher, and then it pretty much went quiet thereafter, as to be expected, with US was also closed on Monday. But yesterday, the DAX, let's look at the S&P was, and the US assets were quite interesting, because it almost felt like the market was still in very pro-Trump economics mode in regards to this whole fiscal play about that being an economic boost to US growth going forward. Certainly the dollar, let me just transition my chart or my screen. This was the dollar index, and what you're looking at here is the gap up when we reopened from the weekend, and then as soon as Europe came in, this is 7 o'clock here that I've just got my cursor on, and we shot higher as soon as Europe came in, and really aggressively actually, and that put consequently some heavy downside pressure on both major pairs. It wasn't really so much a euro or a pound story, it was all dollar led. The dollar index was up well in excess of 1% at the high, and obviously the high point that you can see here, that wick on that green candlestick, that was on the back of the ISM. Just a quick look at ISM to refresh you. It was the highest reading since December of 2014. New orders, production, employment constituent, which is obviously going to be very important because we get non-farm payrolls this Friday, and that is something which analysts will look at for underlying sector strength, let's say in the manufacturing part of the economy, for the employment situation. They all registered, those sectors, new highs for the year of 2016, because don't forget this is December data that we're looking at. Putting on a 5-year basis, you can see here, you can see the reasoning why the Fed did raise interest rates with some confidence in December, and obviously we'll talk about that as well shortly. You've got the FOMC minutes later this evening, which will be looking to see further discussions around that hike that we had, and also those latest summary of economic projections, or the dot plots. But you can see here in terms of a ISM manufacturing PMI, very strong, up at 2-year highs. And certainly that acted as another catalyst for dollar strength. But pretty much after that, we then started to see a fairly aggressive reversal with really no real headline-inspired reason. It was more, I guess, possibly a bit of profit-taking. This was an exceptionally large move throughout the European morning on really not a hell of a lot. Again, like I said, it was kind of felt more like a follow through of the whole kind of Trump view, and how that government spending angle will help boost economic growth in the US. But when that reversed, the markets then started to see a bit of a change of direction. And I think if we just go back to the equity market in the US, that certainly was quite an interesting ride. You can see the candle where we initially printed the best level of the day. That was on the back of the data, surprisingly strong. Took a bit of an added boost after we broke that 55 and a quarter. You can see it sort of spiked high. You have that wick, it then came back to that level We tried to move higher again, but then started to see quite a strong move to the downside. Now, this is when you've got to be watching, I guess, your correlations quite closely. And one of the big movers yesterday was crude oil. Now, crude oil was also a game of two halves, so to speak. Bit like Arsenal last night. But you initially had quite a strong bid. Again, when Europe came in, don't forget, as we were talking about yesterday morning, you had the 1st of January marks the commencement of the OPEC. Officially, those cuts, which were agreed at the end of 2016, have now come into play. And as such, it seemed like the market was wanting to buy into that idea. I think if we look slightly longer dated, well, you can see it here on a monthly continuation. We broke that 54.51, which obviously was that high that we had at the end of last year, 2016, and that meant we were printing up at 18-month highs. Now, we've been on a pretty steady upward trend really since that November OPEC meeting and those decisions and agreements to cut production, both OPEC and non-OPEC, which has seen people adding to net long positions in speculative futures trades for 7 consecutive weeks, and that's not happened since March of 2014. So certainly a lot of longs in the market. That was kind of added to in the morning, a technical break of those levels we just looked at to fresh 18-month highs, but then you had a really aggressive pullback, and this was post-data. You can see oil fairly unreactive to the data at 3 o'clock. Then we started to see not just a reversal of the move, but within pretty quick succession, once we had reversed the entire up move in the European entrance, when pivot gave way, S1, S2, pretty quick fashion. You can see that S2 tested it, then came all the way back pretty much up to S1 before then pushing lower again. I mean, you're looking at a move from around $55 down to 52. And at the time, there was not one single headline to kind of base it on. But inevitably, as we were kind of talking about, news agencies will try to pin a reason, and for those who didn't catch it, because I think I tweeted it out after most had gone home, but these are some of the reasons that were being spun. So here's a couple. Kurdistan have not agreed to participate in the crude oil output curtailment and is reportedly ramping up oil sales, which impacts Turkey, Iraq, Syria and Iran export numbers. Separately, some suggesting that Libya, Nigeria, who are exempt from the cuts, have both already made progress in restoring output faster than expected, so obviously both these bearish factors. There's also headwinds of a stronger dollar, no doubt. That was definitely a prevalent theme, although it did pull back slightly. It was still a strong day for the dollar. Natural gas as well, there was quite a few people looking at. Natural gas, I mean, it's more of a sympathy play rather than a direct impact. But when one product in the energy complex, like nat gas, is down significantly, as was the case yesterday, it was down over 10%, it can have a bit of a read across. But again, I think that all of these reasons are somewhat trying to find a reason for why it moved lower. But I think ultimately, when you start to see some technical breaks and then the momentum picks up, you start to get people chasing the price, and then it all kind of becomes a bit self-fulfilling and you start to power lower. The nat gas weakness, just so you're aware, for any of you who do in the future go on to trade nat gas futures, this is very weather oriented product, and what people generally do is they monitor North American weather forecasting over a short to medium term basis, which basically means 6 to 10 days. That's how far forward the market in nat gas futures will price on weather expectations, if that makes sense. So what happened yesterday, nat gas was down very heavily, updated weather forecasts on a call for warmer than usual weather in the southern half of the US and parts of the Midwest and Northeast by mid-January. And hence the price came off very aggressively. So a couple of explanations there as to why crude oil may have been weak. I wouldn't really read too much into these, but certainly, how do I find this information? That's another question I often get. This is called Briefing, this snapshot that I'm sharing with you. This is actually like an online platform which I would say it's probably more stock specific than it is macro, but obviously they do comment on things like this. But the easier way, as you know, Twitter, TweetDeck, if you use the hashtag OOTT, and just generally speaking, when I'm seeing like volatile moves without much reasoning, or and I'm not hearing anything on the Squawk or headline feed, that's definitely where I go to just quickly check whether there's anything that's come out that may have been missed or unnoticed by the broader market to try and get a bit of an edge. And so that's where I pick up information flow like that for future reference. So oil, definitely one to watch. I think the way that oil has moved, I mean, just go back to a monthly, still feel more bullish, generally speaking, at this point in time. $60, I think, kind of has an inevitability about it to a certain extent. It's just a matter of how long it will take to get to that point. And obviously, the higher we start to creep up, one thing that I would be interested in just monitoring is the performance of US output, and then operational US rig counts, which we get at the end of each week. I'm not expecting that to be an immediate change, but it will be something I'd be continuing to monitor week after week as this price continues to track higher, if it price goes higher. Just as I speak, WTI just touched a session high, and we're just looking to move back to the $53 handle, so we're already looking to pare back some of that. The other catalyst as well, not to forget, we did have the Genscape Cushing figures yesterday, which did come around the time of that fall. And just to repeat, that was a build of 1 million, which is quite large, but certainly in the recent numbers that we've seen from that specific data set, I'd say that's relatively moderate. And I wouldn't say that explains on its own that entire move, but certainly does set the scene. We'll get the APIs later tonight and the DOEs on Thursday, a day later than normal, of course, because of the holiday. A couple of other things that I've seen in the news that I thought I might talk about. One being Brexit. Obviously, it's going to be a real hot topic over Q1 specifically. And this did come out yesterday afternoon. It didn't really get much airplay. Certainly, I don't think it had much of impact yesterday afternoon on the sterling currency, but it is getting pumped by the major news agencies this morning. And although cable, as you can see quickly on the top right, is performing positively this morning, around the 123 handle or just shy of that, this is more of a reversal of some of the dollar strength, because euro dollar also up just above pivot, so the pair's supported by kind of the opposite play of yesterday morning. But definitely worth keeping an eye on this type of news flow, I'd say, in the weeks ahead. What's basically happened is that Ivan Rogers has quit as Britain's permanent representative to the EU and urged officials working for the UK and Brussels to keep challenging muddled thinking from colleagues in London. Actually, when you read the full article, very damning of the government. He's basically saying the government does not have a clue about what to do with Brexit. And this is a chap who's seen as the most experienced of potential negotiators that was supposed to be on the side of Britain negotiating with Europe, and he's just resigned out of the blue with not really giving any other concrete reason why, but just being very again damning of the government's current plan for Brexit. So again, I'd say a more of a medium-term play, but the more of these types of situations start to occur, I'd say the more negative ultimately it has to be for the pound. The only counter catalyst at the moment is that the cheap currency is still elevating economic data. We had that yesterday. You remember the UK manufacturing PMI was very strong, and that helped kind of sentiment, I guess, to a certain degree. But again, I think the market is going to start to be a little bit desensitized to economic data, which can be pinned so clearly on a weaker currency, because ultimately that will have that effect will start to wear off over time. Other things as well in the news, definitely UK related, sticking with that theme that I have seen this morning. Next, the retailer. Now, I don't know how many of you were following the news over the Christmas period, but I remember reading on Boxing Day about footfall of retailers in London and the UK was down quite substantially on Boxing Day, which is obviously typically a very busy shopping day when the sales really kick off and people hit the high streets. Likewise, New Year's Day was also very quiet. I think that was to do mainly with the bad weather that we had, the rain particularly on that day in central London. But these are things to watch in the future. Next this morning, the reason why I'm pointing that out is that it's not that Next is a big company. It really isn't anymore. But it definitely serves, given its pricing point as a retailer, as something, let's say, that captures the affordability of most people. And therefore, it's seen as a good bellwether of consumer sentiment for purchasing. And obviously confidence that comes with that, with spending money on clothing items. And Next of essentially what's happened pre-market, they have downgraded their profit forecast to the lower end of what they were previously looking for. And what this means, Next shares are down 14% this morning. That's probably the main stock story that you'll see spun in the newspapers. But certainly from a sentiment point of view, that's not looking good for the sector. And obviously, this is another net negative if consumers are not confident in spending money, coming at a time when we're about to enter an unknown period politically in negotiations with Europe. Ultimately, you've got to say that this is fighting against a stronger dollar with an outperforming US economy globally. The downside trend or bias looks quite strong in the cable pair, irrespective of today's move, of course. Just to put in a bit of context so you can see Next, what that looks like, that's what Next shares look like this morning. And actually, they've fallen further than that at this point. So a really quite devastating drop in that share price this morning. So sorry to be the bearer of bad news. Quick look at other things though for today's schedule, just to wrap up things. Looking at the data slate, we've had various services PMI data this morning. As you've probably seen, it's not really had too much of an impact. These are the final December readings, and that's the reason why it has a diminishing value, let's say, for market participants. Later this morning, you get UK mortgage lending and approvals. I wouldn't say that's market moving for the pound itself, but certainly it's something which the papers will talk about. It'll be interesting to see, I'd say, mortgage appetite for that kind of larger ticket item, let's say, for consumers going into this unknown Brexit period of triggering of Article 50. So maybe this is quite backdated data. I mean, we're talking November here, but certainly in the months ahead that could be interesting. More interesting might be the construction PMI, because this is for the month of December, to see whether or not that data remains elevated still. Or do we start to see some deterioration creep in as we get closer to that Article 50 trigger? Elsewhere, Eurozone CPI. Now, this is an interesting one. You remember me talking about a number of the headline readings we were getting yesterday. We were seeing all of the German regional CPIs ticking back up. You had, I think it was multi-year highs in French CPI. Likewise, across Europe, we seem to be seeing now that the ECB have kind of embarked on what you could deem a taper in regards to the actual monthly purchase value, 60 from 80 billion, inflation has started to creep in. Certainly we're starting to see that as quite a global theme now. And what that has meant in terms of prices has been the Bund future has been a very interesting product yesterday, because despite the DAX, it was positive for most of the day. I wouldn't say the price movement was too great comparative to that of the S&P. We've kind of finished pretty flat overall, but the Bund really came under pressure. Now, there's some technical levels that gave way, certainly on the 164 handle, but where we trade at the moment, that pivot looks quite interesting, because I think that downside bias might prevail, at least for the time being. My thinking being, and what you'll probably see analysts talking about, is that this is kind of the biggest threat, I guess, to the ECB's QE program. Because don't forget, although they've reduced the size, which could be seen as a soft taper, they have kept a fairly open-ended date for the duration of the program, which is the end of this year, but they have said they would review that again. They've also tweaked some of the parameters, but ultimately if inflation starts to rise, that can become a bit of a headache, because the last thing they'll want to be doing is broadening and expanding QE on a long-term basis. That's only going to fuel inflation further. So certainly it seems as though some of those prints that we had yesterday from various European nations certainly caught the fixed income market in Europe and caused yields to rise, and consequently bond futures came under some quite aggressive selling pressure. So maybe that pivot to re-enter a short position could be interesting, but I'll be looking at that as we get closer to the level to see how it's reacting at the time. Jimmy, I've just seen that in the live room. Jimmy's one of the live guys just noting as well, Marks and Spencer shares also down around 5%. So you can see how that read across from a sector basis starts to influence other names. Back on the calendar though for the session, and then US wise it's fairly quiet. Certainly during the session when we're here, Chain Store, Redbook, these are just weekly numbers, these aren't really important. The FOMC minutes though, that'll come out at 7 o'clock this evening. A quick look at what the banks are saying. This is just a snippet. I did send it out to you this morning. This is from Bank of America. They kind of summarize it in 3 main bullets. This of course is for the December meeting, likely to reveal modest optimism about the improvement in recent data, but a cloud of uncertainty about how fiscal policy could change the trajectory. Again, this is kind of the biggest theme that I'd be looking for in these minutes. Is they're probably going to be fairly upbeat about the economy. They have reason to be that positive. We've seen that underlying in economic data for a while in the US. It's been fairly robust, none more so than the data, of course, that we had yesterday that cements that view. I guess it's about how do they view what Trump has pledged in his mandate that his administration will put into action via this stimulus for the economy. How much do they talk about that, and how much do they value that? How much has that been taken into account or not at this point? I think will be interesting to kind of judge the future path for policy for the Fed. Otherwise, inflation will be in focus, as we've just talked about. Global inflation, certainly a key to policy going forward. And then thirdly, they'll also look out for any conversation about risk management. Again, Janet Yellen at the time said it was not the Fed's intention to be behind the curve with this policy. So that looking around that similar theme as well will be interesting. So that'll be at 7 o'clock. Okay, so going to leave it at that for the briefing, let you get on with what's to come. Just seeing the DAX here, just touching a fresh low, just flashed on my chart here. I'll be keeping an eye, probably the DAX downside. You've got S1 11,545.5. That, of course, kind of fitting. 51 just above is the low print we had yesterday afternoon around cash close. So the futures low was seen around similar level. So just keep an eye on the DAX. Obviously, retailers UK-wide, and probably read across for European sector as well. Maybe a little bit of negative sentiment surrounding from that next news this morning. But enjoy your session, guys. Good to be back, and I'll catch you in the chat room. Thank you.